Good morning. Thank you for joining us. It is Friday morning, June 24th, and I wanted to spend a little time giving you some perspective about what's going on in the market and the economy. I know it's been quite volatile and a lot of less than encouraging news. I wanted to try to put some of that in perspective. We're going to go through a lot of information. Well, this is not intended to be investment advice or tax advice, but I did want to give you some perspective about the market in the context of history. And then to follow up with this, if you want to visit with us in person or Zoom or phone, we'd love to do that. This is the first part of a two-part series that we've entitled Market Mayhem and Your Retirement. So we've got a lot to cover, so let's dive in. As you know, there's lots of news, current events, headline news. The market is down roughly a little bit more than 20%. I did this, I think, as of Friday's close, it was down 22%. You know, kind of officially or technically, when you get below 20%, that signals the entrance into a bear market. First quarter GDP was negative. The May inflation report on consumer price index, that it was up year over year 8.6%. Some other areas are up quite a bit higher than that. Crude oil is about 111, maybe a little higher, a little lower, that depending on when you actually look at the number. Gasoline nationwide is about $5. Here in Texas, it's kind of $4.65, $4.70, maybe some areas a little higher. Natural gas is about $6.85, and ground beef is $5.40, maybe even a little higher since we put this slide together. Supply chain problems in the news all the time, and in reality, you know, a great example of that is the baby formula crisis, semiconductor chips. They're affecting automobiles and appliances and all kinds of things. There's a labor shortage. There's about 11.5 million open jobs right now. Obviously, the Russian invasion of Ukraine is a horrible human tragedy, but it's also having very significant impacts on economies, inflation, those kinds of things. Here at home, you know, our government debt is up to $3.5 trillion and climbing every day. The Fed is trying to tamp down inflation through the tools that they have, one of which is in the news all the time with aggressive rate hikes. There's rumors of a looming recession. There's, you know, kind of camps are divided about whether we will have or won't have a recession, and if we do, when it'll hit and how severe it'll be, and those kinds of things. There's certainly the rumors of that are out there. We've got a border crisis in Texas, New Mexico, Arizona, California that's creating lots of concerns that will ultimately have economic impact. There is a crime wave in all the major cities, and there's nonstop political discord. So are you concerned? Well, if you are, you're not alone. The University of Michigan, since about 1986, started doing a monthly survey, and they've tracked that in what they call the Consumer Sentiment Index. It's not mathematical. It's not, I guess it's scientific in terms of what it's measuring, but it's not mathematical, and it really captures the mood of the American consumer. And it's based on consumer opinion, their feelings about their financial health, the health of the overall economy in the short run, and their feelings about prospects for longer term economic growth. And they ask 5 questions. Are business conditions better or worse than a year ago? Are you better off financially than a year ago? A year from now, will you be better off financially? What do you think will happen to interest rates over the next 12 months? And do you think prices will generally go up, go down, or stay the same over the next 12 months? Well, how would you answer these questions? I think I have a pretty good idea. If you plot that sentiment over time, going back to when they started it, you know, there's been times where it's been very low and falling. There's been times where it's increasingly up to very positive levels. Down again, up again. Interestingly, now we're actually at an all-time low of the Consumer Sentiment Index since the University of Michigan started tracking that sentiment. If you overlay kind of what was going on in history at that time, there's all kinds of things that were going on. There was in the fall of '87, there was Black Monday. In early 1990, Iraq invaded Kuwait. During that time frame, we had the S&L crisis, followed by a recession. Things got better for a fairly extended period of time. Then the tech bubble collapsed in 2000. We had 9/11, 2001. Following that, when we responded to that, it got a little better for a while. And then the reality of the Afghan war set in. We had the corporate scandal with the poster children of Enron, MCI, and Tyco. We had a SARS outbreak, Space Shuttle Columbia disaster, the Iraq war. Things got better for a while. Then Katrina and Rita devastated the Gulf Coast. We had an economic slowdown. Things tried to get better, and then we had the housing bubble that burst, that were encouraged or helped with mortgage defaults. Lehman Brothers collapsed at that time, and that kind of set things in motion for the great financial crisis that was really from October of 2007 until about March of 2009. Things started getting a little bit better. Then terrorism in the Middle East wouldn't go away. The Japanese nuclear power plant meltdown made everybody concerned. During this time, we had the Occupy Wall Street demonstrations. We had the downgrade of U.S. government debt, which was unthinkable. And we had slow economic growth. Things got better for a long period of time. And then COVID hit, and things kind of that rocked everybody at the core. Things fell off. Looked like we had COVID kind of under wraps, and economies were starting to open up. Things got better. And then we had the debacle that was the Afghanistan withdrawal. Looked like COVID wasn't going to go away as soon as we thought, with Omicron and Delta, or Delta and Omicron, I guess, in that order. And then we were already having supply chain issues. Then Russia invaded Ukraine, which created more supply chain issues, inflation, and then now the Fed's raising interest rates. So lots going on. If you take that sentiment and overlay the S&P 500 over that same time frame, the orange is the actually daily index reading, and the blue is the moving average or rolling average. As you'll notice, sometimes the sentiment index is a leading indicator of where the stock market goes. Sometimes it's a lagging indicator. Sometimes it's completely uncorrelated. But it's interesting that we're at an all-time low of sentiment right now, but the market is incredibly high from historic measures. And we haven't seen near the drop-off in the market that we have in other periods of time, but we've had more of an impact on sentiment. I think it's just a combination of all the things that are going on simultaneously. Don't mean to minimize any of that, because it is very uncomfortable. It does have economic impact on various sectors. But I think it's interesting to look at those things in context and compared to each other. So what's all this mean for your investments, your retirement, your financial security? Should you be doing something different than you are right now? If so, what? How do you make sense of it all? Let's try to put that in context by talking about the nature of markets. And then we'll talk a little bit later about the difference between markets and your portfolio. Over time, the U.S. stock market's been very resilient. This is a chart that goes back. This is a logarithmic graph of the S&P 500 index going back to 1936. During that period of time, we've had recessions, we've had wars, we've had periods where the Fed was being accommodative, the Fed was tightening, more wars, threats of wars, oil embargoes, problems in the Middle East. We had AIDS became a reality, at least in public awareness, in the early 80s. We had the Black Monday crash in '87 that was a bond market issue. We had Oklahoma City. We had the first Gulf War. We had Oklahoma City bombing, long-term capital management failure and bailout. Long-term capital management was a hedge fund, I believe, in New Jersey that kind of sent shudders throughout Wall Street. Following that, we had the tech bubble crash. We had another couple pandemics, and then we had the big financial crisis, 07, 09, more pandemics, trade wars, and then COVID. So, there's been a lot going on. When you're in the middle of one of these storms, it looks pretty bleak. But if you take a step back from 1936 until the end of 2001, actually the end of 2000, the S&P 500 index is up 2,000 to 1, not 2,000%. That'd be 200,000%, but it's up 2,000 to 1 over that time frame, even in spite of some pretty dire events in human history. As most of you know, I'm pretty conservative politically, economically, socially, those kinds of things. But the truth of the matter is, our society here in the U.S. is pretty evenly split between those who are kind of center right and those who are center left. And the truth of the matter is, the markets are actually pretty agnostic when it comes to political party. If you look at this set of bar charts, this looks at various administrations we've had from President Trump all the way back to President FDR in 1936. And what the graph demonstrates is, if you would have invested $10,000 on Inauguration Day of each of those new administrations, left it invested in a good large cap mutual fund for 10 years, how would you have done? Well, the truth of the matter is, there's only one administration that it was negative, and that was 2000, and that was largely a result of 9/11 and the two Iraq wars. But overall, over that look, your return was about 11.6% across all administrations. Amongst administrations that began with a Democrat president, the return has been 11.2%, and administrations that began with a Republican president were 12.2%. Now, irrespective of which side of the aisle you might find yourself on, I'll take 11.2 or 12%. Either one of those are pretty good for a 10-year rate of return. So again, the markets are actually fairly politically agnostic. The other thing to keep in mind about what's driving all our current market volatility and misbehavior, if you will, there are a number of things, but one of the first things to think about is we're in a midterm election year. If you go back to 1931 and look at that of the S&P 500 index back to 1931 in non-midterm election years and midterm election years, there's a pretty stark contrast. In non-midterm election years, on average, month by month, the S&P index is predictably done pretty well, not without some volatility, but it's done reasonably well. Kind of up about 9%. If you look at midterm election years, though, it's quite a different story. From the beginning of the year through, almost before the election, the market is very volatile. We find ourselves, here we are in late June, July, the market's down, and that's no different than it has been in almost every midterm election since 31. And then when the market kind of gets a sense of who's going to win the election, not that they really have an opinion about which party, they just want certainty. But once the market kind of gets a sense of who's going to win the market, it starts behaving, moving up and to the right. And if you look a year after a midterm election, the returns of the market have been more than twice what they would have been in that same time frame in a non-midterm election year. So again, doesn't necessarily mean it's going to happen this year, but history, if history is good, a good measure, it's a pretty good bet that it will be. Now, I will say that I would expect from a volatility standpoint, it'll probably get worse before it gets better. If you look historically, relatively high volatility in June, maybe eases off a little bit in July while some folks are on vacation. Kind of people start wrapping up vacations, heading into the election, volatility gets increasingly higher. And then after we have the election, volatility starts dropping off, and then the market can kind of get back to work. The other thing that's causing market volatility are the Fed rate hikes. The Fed's doing that, as I said, to try to tamp down inflation. And the assumption is, or at least that which the media would have you do, is that if the Fed's raising rates, that's bad news for the stock market. Well, in the short run, it does have some effect, most of the volatility. But if you look historically, here are, I think, 9 or 10 rate hike seasons that the Fed has entered into since 1977. And over that time frame, the average return of the S&P 500 is about 9.3%. Now, most of you don't. There's been some modest years in the 94 to 95 time frame. It was only 4.4%, but it certainly wasn't negative. There's a 5. That's not what we'd like to see long term, but again, not negative. And there's some most of these time frames have been some fairly respectable market returns. Most of you don't own the S&P 500. You have more of a diversified portfolio. Most of our clients have a portfolio that's 60% stocks and 40% bonds. You would expect lower overall returns because of the bond portion of the portfolio over a long period of time. And so, again, overall Fed rate hikes that we've experienced since 77, almost 50 years, 45 years, 60-40 has done about 7.1%. Again, the worst year was about the worst rate hike season was about 2.7. There's 3.4, not very impressive. And these are annualized returns, not the total return during that time frame. But again, even for a 60-40, we've had some high single digits to even low double digit returns, even while the Fed's doing their work to try to tamp down inflation. So again, it creates volatility, but doesn't necessarily portend disaster for the stock market by any stretch of imagination. The other thing that creates volatility, but not necessarily horrible news for the market, if you look at how equity returns have done during different times of inflation, if you look at kind of normal inflation, average 2.3%, certainly, inflation periods lower than what we saw in 2001, the market averaged about 7.4%. Now, if you, in periods of time when there's been inflation greater than 2001, call it 7.6%, the market's still done 5%. Now, again, inflation causes volatility, but it doesn't necessarily impact the overall return of the market. Now, our inflation is higher than 7.6% right now. We just said it was about 8.6 for May. I just heard a presentation by Fed Chairman Powell testifying before Congress earlier this week, and he attributes about 1.5, 1.3% of our current inflation to the Ukraine war, and then the other roughly 7%, a little bit less than 7%, to the fact that we're still trying to get over COVID, supply chain issues, and then the fact that we've overstimulated the economy with all the stimulus that's been put into the economy. So anyway, not a prediction about what's going to happen this time, but certainly history would say that even in periods of high inflation, the market tends to hold its own relatively well. A lot of talk about recession. Again, nobody really knows. There's people who claim they do, whether we'll have a recession, and most people would say that if there is a recession, it probably wouldn't come until 2023, maybe 2024. There's disagreement about if it will be a mild recession or a hard recession. We don't really know. It's easy to convince yourself that it's going to be bad news sooner rather than later. I don't know if it is or not. I hope not, but there's certainly that sentiment out there. But if you look back in history, in 1926, we've actually had 16 recessions, and the interesting thing is that half of those 16, or 8 of those recessions, we actually had a positive stock market return during a recession, and 8 of those recessions we had a negative stock market return. So recessions where we had a positive return, the return during that period of time was actually 21.4%. And the duration of recessions when there's positive stock market returns is about 10.3%. Now, half the recessions were negative, and during those recessions, the average total return during that time frame was minus 16%. Those recessions tend to last a little longer than a year. But again, nobody likes the word recession. It affects more than just the stock market. It affects jobs and things like that. But again, from a market perspective, half the recessions we've had have been met with positive stock market returns, half of them negative. They don't last very long in the grand scheme of things. And the recession, even in the negative recession period or the negative returns recessions, it hasn't been the disaster that many fear it might be. Next thing is, we said that when the market's down 20%, we're officially in a bear market, and we are there. How long we'll be in a bear market, I don't know, but on this graph, these blue highlighted areas below zero or when we're in a bear market. The orange on top of it are when we're in a bull market. I think one of the things that jumps off of this graph is, since 1926, we've had 17 bear markets, but we've had 17 bull markets, 17 bear markets. But the interesting thing is the average gain in a bull market is 161%, and the average length of a bull market is 4 years. The average loss of a bear market is 36%, and it lasts about a little bit more than a quarter long as a bull market. And so again, it's easy to get focused on the bad news that might be associated with a bear market or bear market, But the truth of the matter is, they aren't as severe as maybe we think they're going to be. Some people would say that a mild bear market's actually healthy to clean out some of the excesses in the market. And the truth of the matter is when we switch from bear to bull, it comes back with a vengeance and goes up and to the right pretty aggressively for a fairly long period of time. Truth of the matter is, markets move. They move all the time. They move daily, and they certainly move throughout the year. If you go back to 1950 in the S&P 500, the average return of the S&P 500 has been about 11.2%. But even over that whole time frame, the average peak to trough excursion intra-year has been minus 14.4%. Well, if you kind of bifurcate that into years where we finished in positive territory versus years we finished in negative territory for the S&P 500, on years that were positive, the S&P averaged 17.7%. But even during those years, the intra-year, the high water mark to the low water mark during the year was negative 14%. In years that the S&P was negative, those years, the average was down 8.6%. And the intra-year peak to trough excursion was negative 15.3%. So even in good years, the market's moving around pretty dramatically intra-year. Kind of thinking about it in a different time frame, if you look at the S&P 500 on any given day throughout the year, there's almost a 50-50 chance that it's going to be up or down. 51% probability it's going to be up, 49% probability it's going to be down based on history, going back for roughly the last 51 years. The longer your time frame is, you start looking at how's the market doing. It goes from roughly 50-50 any given day, 60-40 on a month. Get out to a year, it's about 75% chance it's going to be positive, 24% chance it's going to be negative. Get out to 10 years, there's about a 94% chance it's going to be positive, a 6% chance it's going to be negative. And then you get beyond 10 years, there's never been a period beyond 10 years that the market's been negative. Again, most of you don't own the S&P by itself. So if you look at a 60-40 balanced portfolio, again, on any given day, it's almost a 50-50 chance that your 60-40 portfolio is going to be up or down on any given day. If you look at the market, if you look at your portfolio every day, it probably causes you a fair amount of stress. Again, from a time frame standpoint, as you start moving your time frame out from daily to monthly, on out to months, quarters, and years, you start seeing that the probability of you actually losing money over any lengthy time frame is very low. And if you get out to 5 years, there's 92% chance you're going to be positive, and over that time frame, and an 8% chance you're going to be negative. So again, markets move; they have to. If markets didn't move, you'd get CD kind of rates of return. What this really gets to is that markets revert to a mean. If you take, there's kind of a natural long-term trend for certain types of assets, and there's periods of times that the market actually reflects that long-term trend, kind of hugs the long-term trend. There's periods of times where people are more enthusiastic than others, and the market will actually trade above the long-term average. And then they'll get to some point where people think, well, maybe that's not going to last, and so it kind of reverts back to the mean. It may hug the mean again for a while, and then there may be a period of time, in this case, extended period of time, where the actual market's trading below the mean, but eventually people see opportunity, and the market will trade back to the mean and even above it. So again, the economists call that reversion to the mean. And interestingly enough, if you look back over the last 35 years, interestingly enough, we've had 6 years that were exactly at the mean. We've had 15 years above the mean, and we've had 14 years below the mean. So that, if you look at this, if you remember your high school or college statistics class, this looks almost exactly like a normal distribution curve. What all this market movement does is it kind of creates maybe a desire or an impulse or a temptation to try to say, well, I can time the market. I'll go back and look at the times where I think the market's below its long-term average, and I'll buy. And then when I think the market gets above the long-term average, I'll sell. Well, if you're a hedge fund operator or a day trader, that might work for you. But for most investors, that doesn't work at all. I think this is an interesting graph. If you go back over the last 10 years and you invested 10 years ending 12/31/2021, you invested $100,000 and you stayed invested in the S&P 500 for that full 10 years, you would have $462,000, $462,452 at midnight on New Year's Eve. Interestingly enough, if by trying to do something, you missed just the best 10 days in 10 years, that's one day a year, you would have given up 44% of your gain. If you missed the best 20 days, that's 2 days a year, you would have given up over 58% of your gain. And then if you go out here and if you would have missed just 40 days, and that's really just a little bit more than 1% of the days, you would have given up about 75% of your gain. And so while the temptation to time the market is certainly there, the reality is that you don't have much margin for error, and it's pretty easy to miss it and give up a lot of your potential return. If you take a longer time frame, go back, instead of 10 years, go back to 30 years, the S&P over 30 years has done 10.65%, but the average equity investor has only done 7.13%. And the bond market's even worse. Over the last 30 years, the bond market has done about 7.5%, but the average fixed income investor has only done about 3%. Now, there may be more than one reason, but a big part of that is folks trying to time the market, and with the low margin of error that they have, it costs them a lot more than it makes them by a large margin. We said a couple times already, most of you don't own the S&P 500. You don't own the aggregate bond index by themselves. You own a portfolio. So let's focus the rest of our time on the nature of portfolios. Now that we've kind of talked about the basics of the nature of the markets themselves. If you take an individual large cap stock, forward-looking, the market watchers and the economists would say that long-term average for a single U.S. large cap stock ought to return about 7.76%, and about, but it's not that not that calm. About 68% of the time on any given year, we'd expect that return for that single large cap stock to be someplace between plus 37.5 to minus 23. About 95% of the time, we'd expect that single large cap stock to do someplace between plus, call it 68 and minus 23, excuse me, minus 53. And then about 99.6% of the time, that single large cap stock, we'd expect it on any given year to do someplace between plus 98 and minus 84. By contrast, I know it's fun to think about, I'm going to own Apple, I'm going to own Google, but tech stocks over the long haul haven't done all that much better than a single large cap stock, but they've been a lot more volatile. So the average long-term return for a single tech stock is about 7.75 as compared to 7.25 for the single large cap stock, but it's more volatile. So the tech stock any given year, we'd expect it to be someplace between 41 and 26, minus 26, 95% of the time, 75 and minus 59. And then 99.6% of the time, plus 109 to minus 93. You know, what statisticians call that spread, the standard deviation of distribution. Think of it more in layman's terms. One standard deviation occurs about being outside of one standard deviation would be about once every 3 years. Being outside of two standard deviations would be about once every 20 years. And then being outside of three standard deviations would be about once in 250 years. So anyway, I just want to give you a perspective about expected forward return and volatility of a single stock. Again, most of you don't own a single stock. You might own a basket of stocks. But the truth about portfolios are the more risk you're willing to take, the more return it is reasonable to expect. Although reaching for a return doesn't mean that you're going to get it. It's not guaranteed that you'll get that higher return. That's why it's called risk. Concentration of your investments into a single or too few stocks can create outsized risk. We just saw that there's pretty big variability around large cap and tech stocks. You can diversify your risk, or you can reduce your risk by diversifying investments across multiple securities. Most times that's done with mutual funds or ETFs. Most investors can't stomach the risk of an all stock portfolio. The volatility drives them crazy. And the truth of the matter is most investors are better served by not taking that level of risk because the time you need the money, the market may be swooning and that may not work out too well for you. Other things that commonly we do is add bonds to a portfolio to further reduce the risk to preserve capital. One of the people say that stocks make you rich and bonds keep you rich. Another thing we can do is beyond adding just additional multiple stocks, we can add different types of assets to a portfolio. And the truth of the matter is that different asset classes, if you will, perform or react differently to economic outlook and government policy. The degree to which different investment types or asset classes move together is known as correlation. And so just to kind of give you a sense, U.S. small cap stocks are correlated about 80% with U.S. large cap stocks. Real estate, publicly traded real estate, correlates with large cap stocks about 50%, investment grade bonds to large cap stocks about 20%, and commodities to large cap stocks about 13%. So there's some science and a little bit of art in strategically combining different asset classes together such that you can improve your return while reducing portfolio risk. Let's talk a little bit about what that might look like. So if we go back, this is a graph of forward-looking expected return versus portfolio risk. If we plot our single large cap U.S. stock and our tech stock on here, we see the expected return about 7.25 and 7.75, but with standard deviations or volatility in the low to mid 30s. by adding multiple asset classes, in this case, just 4 U.S. large cap, small cap, corporate bonds, and government bonds, you're at a 95% equity, 5% fixed income portfolio. You have given up very little compared to a single large cap stock in terms of return potential, but you've reduced your risk by about 2/3. Not everybody needs or wants to be in a 95-5 portfolio, so you can back down. Again, most of our clients are in a 60-40 portfolio, long-term expected return about 5.5 with a volatility of about 9. So very different picture than these single stocks with very broad variability. I want to assume that nobody really wants to take as much risk as a single stock. And so for the rest of our discussion, we're going to assume that we're in a multi-asset class portfolio. So again, this just kind of cleans that graph up a little bit. This is that distribution curve. So again, for that portfolio, a median return we'd expect 5.5. It has an 8.6, almost 9% standard deviation. So again, about 68% of the time we'd expect on any given year that return to be between +14 and -3. 95% of the time between +23 and call it 12, and then about 99.6% of the time between 31.4 and -20. So it kind of puts that in context. Now, you can better your case even further by adding additional asset classes to your portfolio. And by doing that, you're shifting this curve of risk and return up and to the left, which means that for any given level of risk, you get a higher return, and for any given level of return, you get a lower risk. So we went from 4 asset classes, large cap, small cap, corporate bonds, government bonds, to 9. We added international, developed, emerging market, real estate, and global bonds, and a mid-cap fund in there. So here we have 9 asset classes versus 4. This is all based on ETFs or index funds, but in doing that, we can move the portfolio up and to the left. What that does from a distribution curve standpoint, it does bias the median return up a little bit, not a lot. But what you'll notice is it really starts to clamp in on the width of the variability. 2/3 of the time you're tighter, 95% of the time you're tighter, and then again 99.6% of the time you're tighter. But what we know, what we can demonstrate mathematically, is if you have roughly the same return and lower volatility, you're going to accumulate more in your portfolio. So we've talked about a lot of graphs, and we've done it relatively quickly. So that might leave you with questions. So what? Now what? How do I apply this? How does this affect my financial security? When do I get to sleep again? And how do I get back to my retirement? Well, to keep from making this presentation too long, we've broken this up into 2 parts. The second part is we're going to look specifically at retirement planning and retirement income, and do some historical look at how people would have fared if they were retired back over the last 25 or 30 years. So again, today's conversation was meant to hopefully give you a little comfort about what's going on in the market and how that might affect you and what to expect. Not intended to be financial investment advice or tax advice. I'm glad you participated, and I hope you tune in for part 2. Thank you very much, and have a great day.